Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could, in turn, impact the positioning of our schemes. Global bond yields came down last month, with 10-year US Treasury yield and 10-year German Bund softening by 10 BPS and 15 BPS respectively. However, it should be noted that Japanese benchmark 10-year yield was almost flat at 1.04 and closed higher than 1% for the second consecutive month. Domestic 10-year benchmark yield increased by 2 BPs during the month as state-owned banks have sold gilts worth rupees approximately 103 billion to book profits for June quarter ending. The 10-year G-Sec traded in a narrow band of 7.04% to 6.94% and closed at 7.01% in June 2024, vis-à-vis 6.98% in May 2024. The range has been reasonably maintained due to tug-of-war between demand from offshore investors on account of bond index inclusion and selling pressure from state-owned banks at every rally. At the primary auctions, yields of 91-day T-bill, 182-day T-bill, and 364-day T-bill softened by approximately 5 BPs, approximately 9 BPs, and approximately 8 BPs respectively during the month. T-bill gross issuance at rupees 2.6 trillion for quarter 2 financial year 2025 is less compared to market estimate of rupees 3.5 trillion. CPI inflation for May 2024 printed at 4.75%, marginally lower than the previous month's reading of 4.83%, and also Bloomberg's median poll of 4.85%. Retail inflation moderated to the lowest level since May 2023, largely led by decline in fuel and light index. Food and beverages inflation remained elevated at 7.87% in May 2024, unchanged from April 2024. Within food and beverages, vegetables and pulses and products have been observing double-digit growth in inflation on a year-on-year basis for 7 and 12 months respectively. CPI ex-food and beverages stood at 2.22%, below 4.0% for the 9th consecutive month, the lowest reading in the current CPI series. Core inflation stood at 3.12%, marginally lower than the previous month's reading of 3.23%. In the coming months, CPI inflation is expected to trend further lower owing to favorable base effect. In addition, a good monsoon season this year should augur well for the food prices. During June 2024, US dollar traded with a strengthening bias and appreciated by approximately 1.2% as key constituent currencies, euro, Japanese yen, and British pound, depreciated during the month. Japanese yen continues to remain under stress despite the Bank of Japan moving away from negative interest rate regime. During June 2024, Japanese yen depreciated by 2.3%. It is important to note the relative weakness of Chinese yuan renminbi, Indian rupee, and Indonesian rupiah versus Japanese yen. Indian rupee marginally appreciated in June 2024, supported by strong FPI inflows in both equity and debt markets and favorable balance of payments data. Indian rupee traded in the range of rupees 83.15 to 83.65 US dollars during the month and closed at rupees 83.39 US dollars. Indian rupee continued to remain relatively stable compared to other key emerging economies. FPIs were net buyers in equity markets as the election-related uncertainty subsided. FPI's inflows in the equity markets were to the tune of rupees 26,565 crore in June 2024. Debt markets also noted inflows from FPIs, largely due to the government bonds inclusion in JP Morgan Index. In June 2024, debt markets noted FPI inflows of rupees 14,955 crore. Forex reserves increased to US $653.7 billion as on June 21, 2024, from US $646.7 billion as on May 24, 2024. The outlook for Indian rupees stays favorable for this year as FPI inflows would likely continue in both debt and equity markets, along with potentially higher FDI inflows and comfortable current account balance. However, it remains to be seen how the RBI would keep Indian rupee competitive in comparison to key currencies like Japanese yen and Chinese yuan renminbi. Liquidity conditions remained tight during June 2024 due to outflows related to advance tax and GST, along with muted spending by the government. Although systemic liquidity continued to be in deficit in June 2024, with average liquidity deficit of rupees 54,676 crore, it narrowed from the average deficit of rupees 1,37,736 crore observed in May 2024. In tandem with deficit liquidity, daily average of weighted average call rate, WACR, was higher at 6.64% compared to the previous month's average of 6.63%. Adjusted for the government cash balances which are held by the RBI, the durable liquidity remained in surplus. In the coming months, as more inflows through government spending comes into the system, liquidity conditions could possibly ease. Credit growth stood at 19.8% as on June 14, 2024 on a year-on-year basis, marginally higher than 19.5% in May 2024. On the other hand, bank deposits grew by 12.6% as on June 14, 2024, lower than the month-ago growth of 13.3%. Bank credit growth has been strong, largely led by strong demand through consumer loans and services segment, although bank deposits have not grown in tandem. Higher wedge between credit deposit growth rates should eventually stabilize. While economic indicators continue to show a mixed picture with no clear indication of the direction in which the economy is headed, current data points towards robust GDP, tight labor markets and inflation, though moderating, seems to have stagnated at current levels, with potential upside risks. The intent of the Fed to achieve long-term inflation rate of 2.0% on a durable basis remains a valid hypothesis for now. With better than anticipated economic growth, even though recent data have started softening and tight labor market, the Federal Reserve gets additional time to carefully analyze the developments in the economy before deciding on the rate cuts trajectory. U.S. Federal Reserve does not seem to be in a rush to cut rates. However, in its recent policy, it indicated to reduce the pace of quantitative tightening. Beginning in June, the FOMC stated it will reduce the cap on Treasury securities it allows to mature and not be replaced to USD 25 billion from its current cap of up to USD 60 billion per month. As on June 26, 2024, the Fed's balance sheet size was USD 7.23 trillion, down from its high of USD 8.97 trillion as on 12 April 2022, however significantly higher than USD 4.15 trillion just prior to the quantitative easing in February 2020. Three conditions that make the path for the Fed to start cutting rates much easier are: with the backdrop of strong fiscal spending, keeping interest rates higher for longer increases the burden of the interest expense on U.S. government. Real interest rates are significantly positive. Currently, real rate in U.S. is at 2.9%, i.e. interest rate at 5.5%. PCE for May 2024 at 2.6%. The U.S. Fed's dual mandate of maximum employment with price stability eludes the possibility that an unexpected weakening in the labor market can induce Fed easing, while solid job growth may not deter the Fed from pivoting if inflation is trending lower. However, scenarios of what can go wrong over next few months and the associated risks that remain are: yields at the longer end in U.S. may remain elevated as supply-side pressures persist, i.e., likely strong supply of coupon-bearing instruments due to the elevated fiscal deficit. This factor also gets weightage due to volatility in next few months on account of uncertainty regarding who ultimately wins U.S. elections. Markets would be made to guess the net effect of potential tariffs, domestic-first policies, lower taxes and resultant impact on inflation and fiscal scenarios. Given Japan's recent policy decision, yields of JGB may remain elevated, causing Japanese investors to further withdraw funds invested in UST as spreads compress, It's pertinent to note that Japan is the largest foreign holder of UST at the end of December 2023. Upside risks to inflation remain given the geopolitical conflicts. Copper prices surged by 8.3% over last 3 months, a signal of potential inflation and robust economic health. There has been a strong upward movement in base metals in the past few months, as can be seen in the table. Reasons for being cautious in India are: globally rates remain elevated, resulting in slowdown in anticipated inflows on account of inclusion in global bond indices. While domestic inflation is susceptible to volatility due to food components, continuance of resilient domestic growth necessitates no rush for softening in interest rates. India's GDP for financial year 2024 was at 8.2%, and that in itself doesn't require RBI to look for reducing interest rates. The risk of Indian rupee to have a depreciating bias basis, Public Bank of China, PBOC, may also allow devaluation of Chinese yuan renminbi to make its exports competitive compared to the Japanese yen, refer our fact sheet published in April 2024. Although for now, with flows related to inclusion in the bond indices beginning from June 2024, the Indian rupee seems to continue to be an outperformer amongst the emerging market countries. The deposit credit gap in the banking system has sustained for a while, indicating that the shorter end of the curve may see higher supply due to the battle to raise deposits in the financial sector, thereby putting a floor for the overall curve. However, reasons capping the domestic yields are: the outlook revision by S&P may result in continuance of foreign investors' active flow, with approximately USD 8.2 billion inflows into debt so far in 2024. Flows from offshore investors expected due to inclusion in the global bond indices from June 2024 onwards, which can result in a positive demand-supply equation. A record high RBI surplus transfer to the government's coffers may result in reduction in overall borrowing in the budget to be announced when the new government is formed. At rupees 2.1 trillion, the dividend amount was higher than last year's rupees 0.87 trillion. This will be on the back of lower than expected supply in H1 financial year 2025, borrowing numbers after a lower than expected fiscal deficit. Fairly positive real rates. CPI for financial year 2025 projected by RBI is 4.5%, and repo rate is at 6.5%, maintained for a while.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.